In this current market, interest rates have been rising to counteract the increased cost of living crisis. This can be seen as giving you time to prepare to strike while the iron is hot. You see, while interest rates are high, mortgage rates also increase. This means the market condition for owning properties with mortgages on them is tougher. This will likely result in a market crash in property prices when people are unable to afford to pay off their mortgages. The demand for property drops, which leads to the selling price of property dropping too. But you see, buying property is a great investment because of the potential for appreciation in value over time as well as rental income. These are the following ways your property makes money. 1. Rental income. Renting out the property to tenants is one of the most traditional and popular ways to generate income from real estate. Residential properties, commercial spaces, and even vacation rentals can be leased to tenants, who pay regular rent to the property owner. 2. Capital growth. Capital growth makes money for property investors when they buy a property at a certain price and hold on to it while it appreciates in value over time. Once the property's market value has increased, the investor can sell it for a higher price than the original purchase, realizing a profit equal to the difference. This realized gain, obtained through capital appreciation, represents the money made from the investment. 3. Loan from the bank. You get a loan from the bank of 1 million rand and this gets you a property. You start at 1 million rand debt, where the interest is paid by the rental income from the tenant. You slowly pay it off. The loan tends towards zero, while the opposite happens for the capital growth, as it starts at a 1 million rand property but increases towards 2 million. 4. Benefits from tax. If you make 300,000 off a job, you get taxed on that full 300,000. Compared to 300,000 off a building, you get taxed less as you get certain deductions for repairs, maintenance and interest. So overall, what do you want to have an ideal situation? Income comes from the rental income from tenants. Deductions comes from wear and tear deductions and reasonable expenditure to lessen tax liability. Appreciation comes from the property being worth more in 10 years than it is now. Debt leverage comes from the ability to use other people's money to acquire your asset. Now we will look at the best types of investments. 1. Single-family homes, as the tenant pays the mortgage for you. 2. Multi-family property, apartments, buildings. If one is vacant, then the others will still pay you and so lessens the risk if vacant. 3. Townhouses, good for cash flow, giving tenants more space instead of apartments. Usually cheaper than single-family homes and more spacious than multi-family properties, but usually accompanied by homeowners association payments, so don't forget to consider it in your cash flow calculation when seeing if the property is worth the investments. 4. Short-term rentals, any of the previous properties but for short terms, Airbnb. You get a lot of payment because people will pay a premium for it. Comes with higher expenses and more labor, usually also tough to keep things in order. Having said this, if you're going to invest in property, it's important to do your research and find the right location and the right deal for you. That way, you can get the most out of your investment. I hope you enjoyed watching. Subscribe for more financial content.